This is Aaron Engelman from Two Teachers Tax Service in Lyman, South Carolina. Today, we're going to talk about the differences between tax credits and tax deductions. Tax credits and deductions help to reduce your tax liability. Now, a tax credit reduces the actual tax that you owe dollar for dollar. A tax deduction, on the other hand, lowers the amount of your income that's subject to tax. Both operate differently within the U.S. progressive tax system. So let's talk about tax deductions. Here's what they do. They reduce your adjusted gross income or taxable income. Deductions are subtracted from your total income. So in this example, in the 22% bracket, a $1,000 deduction lowers your tax by $220. Here's some common examples of tax deductions. First, the standard deduction. That's probably the biggest deduction for almost everybody. Or itemized deductions. And part of itemized deductions are the mortgage interest deduction, the deduction for state and local taxes, also known as the SALT deduction, as well as charitable contributions. Contributions to certain retirement accounts, like traditional IRAs, are also a tax deduction. So let's talk about tax credits. They reduce your tax bill dollar for dollar. So here's how that might work. A $1,000 credit lowers your tax bill by $1,000, whether your tax rate is 10% or 37%. Here are a few common examples of tax credits. The child tax credit, the American Opportunity Tax Credit, the Earned Income Tax Credit, or the Credit for Child Independent Care. Here's some differences. First of all, the impacts. A tax deduction reduces taxable income, where a tax credit reduces your tax liability. A tax deduction, the value depends on what's your marginal tax bracket. So those in lower tax brackets do not get the same benefit as perhaps somebody in a higher tax bracket. And a tax credit is a fixed dollar amount regardless of which tax bracket you're in. Here's an example in the 22% tax bracket. A $1,000 deduction equals a $220 tax savings. Now, the tax credit, on the other hand, in the 22% bracket, a $1,000 credit is a $1,000 tax savings. So the goal of a tax deduction is to lower income subject to tax, where the goal of a tax credit is to directly reduce the amount of tax owed. There are both refundable and non-refundable credits. So let's talk about that. Refundable credits, first of all, can reduce your tax bill below zero. And if your tax bill is reduced below zero, IRS pays the difference as a refund. Now, what if your credit is more than your tax bill? Well, you get a refund. Here are some examples of refundable tax credits. The Earned Income Tax Credit, that's also known as the EITC, and part of the Child Tax Credit, or the CTC. Non-refundable tax credits can reduce your tax bill to zero only. Any excess credit is forfeit, and you do not get a refund if the credit is more than the tax bill. So if you have a $500 tax bill and a $1,000 credit, you pay zero, but you also lose that extra $500. You may want to have some strategic tax planning. Your tax professional can help you maximize credits as well as your deductions. Always be sure to claim all eligible tax credits. They provide the most direct reduction in taxes owed. Two Teachers Tax Service will help you minimize your tax liability. And for help, please contact us at 269-449-8277 or by email at twoteacherstax@gmail.com. Thank you.